From the morning reading, spiders, Qs, diamonds, IWM pause, eBay, QCOM gain on earnings per share, Intel drops on earnings per share, after hours, AMT gains, Smith & Wesson falls. 2 of 9 sectors moved higher on Thursday. XLU, XLV, XLY were the strongest sectors, while XLI was the weakest sector. Oil futures fell $1.12 to close at $44.54. Breadth weakened compared to the prior session as decliners led 17.19 to 12.54 in the New York Stock Exchange and led 15.99 to 9.64 on the NASDAQ. The Dow slumped with 24 stocks moving lower, with weakest stocks Intel, AXP, Nike, Goldman Sachs, Home Depot, and Bank of America. Just 6 stocks rose, including McDonald's, Caterpillar, and Pfizer, J&J, and Merck. So the healthcare sector components of the Dow were seemingly doing pretty well. On the S&P 500 snapshot, a modest decline, but off the intraday low. Asian markets were up with rumors of a big stimulus package in the works, but the optimism didn't spill over to other major equity indices. The Euro Stoxx 50 closed with a tiny 0.05% gain, and the big 3 in the U.S. lost ground. The S&P 500 hit its 0.07% intraday high shortly after the open, traded sideways, and then sold off in the late morning, hitting its 0.61% intraday low early in the final hour of trading. Some subsequent buying trimmed the loss to a negative 0.36%. The yield on the 10-year note fell 2 basis points to close at 1.57%. Economic reports have been beating expectations. That has pushed the Citigroup Economic Surprise Index to its highest level since December of 2014, fueling hope for bulls that recent highs in stocks are not a fluke. But when both stocks and economic reports have been hitting highs, most gains are already baked in. Bonds and gold tended to struggle, while the dollar rose over the next month almost every time. Sentiment surveys are showing some of that optimism. The AIM model, which aggregates many of the major surveys, jumped to 85%, an unusually high reading when stocks have been at or near a high. Further gains after similar extremes tended to be muted. Gold stocks jumped after seeing extreme pessimism. We noted that the optimism index on the GDXJ, the gold miners, dropped below 10 on Wednesday, and on Thursday the stocks rose more than 5%. This provides some confirmation that the uptrend can still generate interest among buyers. The S&P 500 streak is above its 5-day average, and that has ended. We took a look at the streaks and a good medium-term sign of momentum. When the streak ended, there was a slight tendency to see a downside follow-through in the very short term. The S&P fell the next day 9 times and rose 7 times. But a week later, the S&P was higher 14 of the 16 times, with the 2 losses only being 0.3% and minus 2.3%. The rebound didn't consistently last beyond the next week. A little over a month later, stocks were higher only 6 times. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:47 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 22nd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce into our morning report. And here we go. And at the time of this cut, things were slightly positive across all 4 of the U.S. broad market indices. The S&P futures are up about 4 points, or about 0.2%. Russell futures are up about 1/3%. NASDAQ and Dow both slightly above scratch. Crude oil slightly below scratch. Euro slightly above scratch. Bonds slightly below scratch. And gold down about 0.5%. In overseas action, it's mixed, with Asia all negative. China down about almost 1%. Hong Kong down just below scratch. Japan down about 1%. Germany, though, is at scratch. And the United Kingdom is up about 0.43%. In terms of macroeconomic reports for today in the United States, there's really nothing on the schedule. You have one yellow flag report, not expected to be a significant market mover. In terms of the current volatility conditions, obviously we had a little bit of an increased volatility yesterday, but these are coming off exceptionally low levels. Short-term VIX at 11.50, skew just barely into the cautionary area. IV percentiles all still single digits. The S&P at a 7, the Russell also at a 7, the NASDAQ at a 3, and the Dow at a 5. No standard deviation moves were put in on any of the 4 broad market U.S. indices yesterday. And indeed, if you look at the last 2 weeks of activity, slightly below average, and certainly in the last 1 trading week, the number of large moves has certainly dropped off. Let's go ahead and bounce over to the charts. And this is the S&P futures. And you see that yesterday's action, in many ways kind of nullified the day before. It's not technically a bearish engulfing on the futures chart, as the open price was just inside this candle here. But certainly it has the spirit of a bearish engulfing candle, given the size of the 2 relative bodies, and there's only a very minor difference. It certainly is a bearish candle. And perhaps you could call it a dark cloud cover, but it actually is beyond dark cloud cover in that it does close below the prior day's open. Bottom line to all this is that we had a little tickle of a breakout and then kind of nullified that. So it just seems to be grinding higher, and we certainly haven't had any kind of exhaustion or capitulation buying or anything like that, it would seem. This has been on relatively low volume. We'll look at the SPX, and you can see here, let's see here, 72.91, and much like the futures, just below. But bottom line, it's a bearish candle. We don't have to get all worked up into the critical definitions of candlesticks. One thing I was thinking about with the SPY, so this is your cash market that closes when the cash market closes. And, that clearly is a bit bearish as well. And I was going to look at the volume down here. Look at the volume. Just really, really low pretty much all week here. All these volumes very, very low compared to normal volumes. So, while we had a little bit of sideways consolidation, a little bit of a tickle up and a new high put in, the whole week is on very low volume. So not a lot of institutional participation in anything this week, up or down. In terms of the Dow, much the same thing. We can take a look at the diamonds, the ETF, just to see if they're, the volume. Look at this, just anemic volume. You can see what kind of volume you get when things get active, and really, this is just kind of classic sideways volume kind of action going on here. And then let's take a look at the NASDAQ. A little bit of a pullback, perhaps not as bearish as the Dow or the S&P. And the Russell's just flat out sideways, not really making any headway either direction. Crude oil was negative yesterday. So far today, slightly up from yesterday's close, but still in this either channel or wedge pattern. We're still waiting to see if this thing matures into something more easily definable. Right now, we're calling this a wedge pattern, though. And that's certainly not indicative of anything significant happening yet. It's still neutral, still in the cloud. You know, though it does seem to be crawling towards the lower part of the cloud, not doing so at any kind of particular earnestness, though. Let's take a look at volatility. Volatility, of course, has ticked up in the last few sessions. But it's coming off at exceptionally low levels. And then bonds. Bonds is the other market we like to keep an eye on. Bonds, you know, obviously bonds and gold have been in something of a retracement, and money seems to have been flowing out of the safe havens and into the more risk-on kinds of areas. We also have been watching to see what happens with utilities. Utilities has been holding its own, and staples gave up a little bit yesterday, and it's a little bit of a sell signal that it's come in, but still, you know, no serious breakdown as of yet. Perhaps some signs of rotation out of some of these stubs groups, the staples, utilities, bonds, and transportation. And I shouldn't say transportation, I should say telecom. Telecom clearly has been giving it up. So I think we, at first, we weren't seeing much in the way of rotation, but during this week, on low volume, we have seemingly seen a little bit more rotation out of the stubs, the kind of safe haven areas, into more risk-on behavior. Though at the same time, while perhaps we're seeing a little bit of that rotation, we're not seeing that the broad market indices have made any kind of significant gains at all. When we go back to the S&P, if we go to the weekly candle, and you see we've got something of a perhaps a spinning top here. Obviously, we've got one more day to go before this candle closes. But you have the breakout, and then you have this kind of potential spinning top up here at the top. So, you know, not terribly bullish. It could potentially be a sign of indecision or a potential reversal, but that action hasn't come through yet. Certainly, the momentum has slowed. We can say that much thus far from the prior week into this week. Okay, that's probably enough on the charts. Let's go ahead and go to the daily report. And with kind of such a slow week in terms of achieving anything, well, there hasn't been much in the way of change on this report. On top of the report especially, it's still intermediate term phase 2, trend reversal, the break of diagonal, and now horizontal resistance. Our three market timing signals haven't seen a change all week, really. The first signal from IBD is a confirmed uptrend, full out bull. GMI index is at a 6 out of 6, a buy signal since 7-1. And the decision point scoreboard is still sitting here with a nice stack of bullish signals on the short to intermediate term against a backdrop of a mixed signal on the long term. Now, within this, I would tell you it's not quite as rosy as perhaps most of this being green would tell you. These short-term signals are getting very close to going to neutral. So if they're going to hold up the bulls here on the short term, a little bit of positive action needs to come in pretty soon. We're going to get a change in signal strength there. In terms of position sizing opinions, they're still both at 100%. These are both mechanical systems, one based on portfolio and one's based on a volatility for a more active trader, both at 100%. And the intermediate term market posture, and this is our primary trading time frame. You see all four indices are exceptionally strong. Severely strong is how we defined it when we're up over 80, and indeed all these are up practically 95 and above, so there's not much room left for them to go much higher. They are supported with a bullish sentiment line, so this is pretty much all bull all the time on this time frame across the U.S. indices. The strength of the trend is still considered quite strong. No changes there. Hedge warning status still remains level 0 plus, normal with some cautionary aspects. No change from yesterday in the strategy opinions. The VIX is acceptable to initiate new positions. Just keep in mind that at some point we're going to get an expansion in volatility. Be ready for that. Make sure your position sizing is appropriate. Cover call strategies. I Started to initiate one yesterday, got into the stock, still didn't get the covered calls sold. It is, it's tough to put on a lot of new positions coming out of earnings, and was, well represented across my watch list. So I was wanting to start to put something together there, but I certainly haven't been super active. And this week, as we've had this low volume kind of activity, and we seem to be, if not exhaustion, and we haven't had the volume to be exhaustion or capitulation or anything like that. We certainly seem to be setting up, from many of the sentiment indicators and other indicators, to be setting up for something of a pullback. So waiting for that pullback primarily, especially for put selling. I've got a number of things I'd like to sell puts on. And if we get a little bit of a pullback, it'd be a lot easier to put that on than it is at these levels. And I think, frankly, that's what you're seeing from the institutions as well. They're not willing to really put a lot more money in at this level. They're waiting for a better level, and yet at the same time, there's been enough bullish activity to kind of hold up the level to date. So we'll see where that goes. And eventually, the bulls and bears will have some sort of imbalance, and we'll start to see something, actually move. We are in summer doldrums. We've got to always kind of keep that in mind. Volume is normally quite anemic during this time of year. In terms of the specific warning areas from the volatility basket, there's only these two very minor warning areas, and they're just barely, into that cautionary area. Nothing really to get excited about. We did have distribution days on both the NASDAQ and the S&P yesterday, but the count is only 2, so that in itself isn't terribly alarming. In the trend-based area, this was all bullish all the time. In fact, the New York Stock Exchange had 410 new highs yesterday for the month. In terms of the key intermarket risk aversion indicators, all 5 still risk on. I don't see any deterioration showing signs yet of those indicators. In terms of sentiment, short term has kind of scrubbed off back to neutral. Medium term, slightly elevated. And in the ETFs, we're watching the semis and retail particularly as being somewhat excessive sentiment, looking for potential reversal patterns. And the fear and greed index came off a little bit from some previous closes that we've had of late, but we're still in the upper quartile at 85, extreme greed. So continue to watch for those signs of reversal across the indices. We did have some deterioration yesterday in the sector percent change area. And in terms of market posture, specifically short to intermediate term, transportation, telecom, consumer staples, and energy are all now neutral in that short to intermediate term. So think about what I just said a little bit ago about those stubs on the charts. Well, here you go. Here's transportation. Here's telecom. Here's consumer staples. You have utilities actually went from a neutral to up. So just kind of barely signaled across the line, but many of these stub areas are perhaps not quite as strong as they were, say, a week or so ago. Whereas the higher beta areas, while yesterday was weak, they gave up. That's not been really the case so much all week. And you see like information technology up for the week, though that's probably the biggest one to make a case about. Many of these are slightly down. Here's discretionary down only 0.18% for the week. Let's see, another high beta area. Here's materials down 0.08% for the week. So there does seem to have been a little bit of rotation activity, but this isn't terribly exciting, movement as of yet, but it's perhaps some of the first green shoots that we're starting to see some rotation activity. Okay. Well, we're right at 20 minutes now, so let's go ahead and wrap this up. We'll go ahead and go to the disclaimers, And of course, we always have disclaimers in this business. If you need more time to review these disclaimers, just hit the pause button. Also note down here at the bottom the hyperlink that'll take you to the full set of disclosures. We'll see you back here next for Monday's trading session from Falcon Global with the market preview. In the meantime, manage that risk and go learn something.